If I had to go back 5 years and restart trading, I would have done it completely different. When I first started trading, there wasn't a such thing as being able to get money from other people to trade. And it seems like a weird concept, but nowadays it's the most popular way to trade. And if you don't know what I'm talking about, I'm talking about prop firms. Prop firms have recently become the biggest craze in the trading industry, where you can get funded up to millions of dollars and be getting paid out millions of dollars. One of my good friends, Kane, just got paid out by Apex Trader Funding $1.9 million, which is the biggest payout in trading history. And this got me thinking, if I had funding back when I first started trading, I would have made my first $100,000 in the market way sooner. And I want to break down exactly how I would do it if I had to go back in time and restart trading. So first thing I would do is I would be looking for a proper prop firm, meaning that they've paid out millions of dollars, they're reliable, and I would be looking at the affordability of the prop firm, because when I started out, I didn't have a lot of money. So I have to make sure whichever prop firm I would have used would have a decent price point. Now, after doing a lot of research and using a lot of prop firms, I found 3 prop firms that I like the best: Apex Trader Funding, My Funded Futures, and Topstep. The plan of attack for when it comes to trading prop firms is to get as much funding as possible and be able to make the most amount. Now, that doesn't exactly mean buy the biggest account they have. In fact, I think the best strategy that I've come up with is buying 20 $50,000 accounts from Apex. And you're probably thinking, 20 accounts, how much is that going to cost? If you click the first link in the bio and use code OBI, you're going to get 80% off the accounts you buy. And that's going to leave it under just $700 for all of those accounts combined. Then all you have to do is make $3,000 on it to get funded. Then all you have to do is make $3,000 on each account to get funded. Once they're funded, all you have to do is make another $3,000 and you'll be able to withdraw money from the account. Now, I'm leaving out one important key detail when it comes to Apex accounts in specific. It's the activation. The activation fee can usually be $100 something. If you use code OBI, you get $85 lifetime, meaning that once you activate the account for life, you won't have to pay monthly. It'll just be a lifetime fee. Now, a lot of my students have actually went through this exact phase of buying a bunch of accounts and passing those accounts. As you can see, Brent here, he got funded $5 million because he bought 20 250K accounts and passed them all. And he recently just got his first payout ever as well, meaning all the accounts he bought, he is now green on them just off of trading prop firm. Now, I want to dive deep into the exact strategy that I would personally trade to actually make $100,000 with prop firms, trading them as if I was a beginner. And without further ado, let's go onto the charts and let me show you exactly how to trade my strategy that's helped me get funded over $2 million in one single week. So right now, we're going to be going over basics of liquidity. This is going to be the exact framework and strategy that you should use if you're trading prop firms. I think that this is the one that most people will understand the best. It's a little complicated, but it's the best and highest win rate strategy I have in my playbook. And I want to go over it today in a little specific. And you're probably wondering, Shano, like this type of stuff we're going to go over in this video, people will charge you thousands of dollars for, right? You know, I could sell you this in a mentorship, but I'd rather teach it to you for free and help you implement it inside of a Discord or whatever the case is. So make sure you're paying attention, because this video is going to help a lot of you guys become funded. Now, this is under the assumption you're trading $50,000 Apex accounts and you have 20 of them. This is the strategy I use to get funded $2 million in 1 week. So first things, we have to understand liquidity. And there's 2 types of liquidity: internal range liquidity and fair value gaps. Internal range liquidity is fair value gaps. And now, what are fair value gaps? A fair value gap is used to define imbalances in price action on the chart, right? It creates some sort of gap where the market retraces into it to rebalance the market. And it looks something like this. It's a 3-candle pattern. Here's the bullish one, here's the bearish one, right? Understanding FVGs is only half the battle. Understanding why they work is equally as important. And this is the analogy I always use. Imagine you have a paint roller and you dip it in paint and start painting a wall, right? Instead of painting slowly, you move the roller up super fast. What does that do? That leaves behind unfilled gaps in the paint. And to fix that, you have to go back over it, fill in the gaps, and continue painting, right? So in the markets, someone buys an institution and they buy too fast, they buy too much and too fast at once, and then the market leaves behind unfilled orders that they have to go back over, fill those orders to continue moving in the direction. So the market makes a swift move, leaving unfilled gaps, like right here, and then the market retraces back into it to recollect the unfilled orders and continues moving in the direction it was moving. The second type of liquidity is another one, this is super important as well, is external range liquidity. External range liquidity, when we talk about liquidity, we're looking for liquidity pools where stop loss orders and pending buy and sell orders accumulate. These are places where institutions target to fulfill their orders. These are most commonly found near swing highs and swing lows, right? Swing highs and swing lows are just previous highs and lows. There's two types of external range liquidity. There's buy side liquidity and sell side. Buy side refers to where the stops are at swing highs. Buy stops are at swing highs because people who have shorted, they have their stop losses at previous highs. So when they get stopped out, they have to buy in order to close their position. The sell side is at sell stops, which is the lows. The reason why these are called sell stops is because people who buy, they have their stop losses at previous lows. Once those hit, they have to sell their position. We use these areas to look for reversals. We call these liquidity runs. A liquidity run happens when price spikes towards liquidity pools, grabbing stop losses before reversing. This is referred to as a stop hunt. Notice how the previous high was swept and then reversed, right? People who were shorting these pops, they have their buy stops at this previous high. It gets there, they get stopped out, and then the market moves over. And a lot of you guys watching this probably have bought above previous highs, expected this to continue higher because there was a candle close, or we're breaking above a previous high, we're breaking above resistance, and next thing you know, this happens. You, in that scenario, were liquidity. Now, here's another example of a buy stop run. We have a previous high, we swept it and continued lower. Most novice traders would be buying up here expecting a move higher, but instead it sweeps and continues lower. Here's an example of a sell stop run where people who have buy orders at these impulses up, they have their stop losses at this low, they hit the low, they get stopped out, and then the market reverses because they were used as liquidity. So stop run and liquidity sweeps are interchangeable terminology, right? So here you can see we have buy stops. This is the main part of the strategy. We have buy stops here. We're looking for a move to these previous highs, but how do you find an entry, right? If you're trading these prop firms, you need to have a really good entry model, and those are inverse fair value gaps, right? And if you don't know what inverse fair value gaps are, go to my last video and watch over it, and it'll explain everything to you. So what you're looking for is to go on the 15-minute time frame and define, did we take out external range liquidity, or are we in internal range liquidity? What you're looking for is you're looking for external range liquidity, and you're looking for an internal range liquidity move to buy and target that external range liquidity. This little part of the chart turns into, this is a bullish fair value gap. So we're looking at this 15-minute fair value gap. We're looking for the market to retrace into this fair value gap, and we're looking for a 1-minute inverse fair value gap to then target to that previous high. It might sound complicated, but stay with the process. So here you can see the 15-minute time frame retraces into that 15-minute fair value gap. We go over to the 1-minute time frame. What we're looking for is an inverse fair value gap to enter. Once we close above, you can place your buy orders, sell stop at the low, and then have your take profit at external range liquidity. And this is the move you get. This move alone would have gotten you enough to be funded. Now, this move doesn't happen often, but it does happen very regularly inside of the markets. So here I want to show you guys an example of a 15-minute time frame fair value gap that we actually took for longs today. Today was Wednesday, FOMC, at 10:30. We had this 15-minute fair value gap, right? And then in that 15-minute fair value gap, we're looking for a move to previous highs, which is this untapped liquidity here. If I go on to the 1 minute time frame and show you guys that 15-minute fair value gap, what you're going to see is a very nice inverse fair value gap forming. We close above. We have our stop loss at the invalidation of the inverse fair value gap. And then from there, you could see how the market reacted. A 3-to-1 risk to reward ratio. If you're trading a 50K account, you can easily take 2 of these and be 75% of the way from passing by risking $650. I want to do some quick math here. For a 50K account, right? For a 50K account, your profit target is $3,000. So this $3,000 is what you have to make while you can only risk $2,500. Right? You have to make $3,000 without losing 2.5K. All right? This is your rule. Now, to get to that, all you have to do is have a 3-to-1 risk to reward. You target max $1,000 per trade. That means if you were to lose, you would only lose $300. All right? So that means in theory, you could have 8 consecutive losing trades and still not hit that negative 2.5K mark, but all you need is 3 green trades to hit the $3,000 profit goal. Now, the size I would recommend is 10 MNQ or 1 NQ. Now, if we were to take this trade with only 1 NQ, look at how it matches up with our risk to reward. You would have risked $300 to make $1,000. Right? And throughout the course of a week, if you take this exact setup 3 times, the chance of you winning 3 back-to-back trades is pretty high just because of how good this setup is and how good and accurate this entry model is. If you were to do it 3 times, in this week I could show you 3 examples of when you could have taken it. You had a 15-minute fair value gap here. You could have targeted this high, right? And this is from yesterday. So if you go into the 1 minute and go to that exact setup, you would be able to see an inverse fair value gap on the 1 minute. You would have your entry most likely at this high, stop loss at the low, targeting that high. Matter of fact, you would target a 2-to-1 minimum, and you would have risked $860 to make $1720, right? Or you could have waited for a retest of that fair value gap to the 50% mark. Then you would have had $540 risk for $240, right? You would have been able to find the setup every single day this week. That's just yesterday and today. You would have passed that account. If we look over here, here's a 15-minute fair value gap that we traded into. Here's a previous high. And this is the example that I showed on the whiteboard. This is what would have happened. So every single day this week, this setup showed up and you would have been able to make money, right? Now, it's not going to be super easy, but this is the strategy I use to get funded. And if you guys want to get funded, make sure you buy a cheap account first, learn the ropes, and then move on to the better accounts, right? I recommend Apex for beginners just because it's cheap. You guys can use code OBI to get 80% off. It'll be the first link in the description. You guys can test it out. Try with 1 account first. Once you pass your first account, then move on to 5, then 10, then 20, and then copy trade them. But guys, this is a literal cheat code in the markets as of right now. And if I had this when I first started trading in 2019, I would have made my first $100,000 in the market way faster. If you guys found value in this video, make sure you guys use code OBI to get 80% off on Apex Trader Funding. And if you guys want to see my trades live and see how I actually trade the strategy, the second link in the description is my completely free Telegram that you could join, where I post every single trade I've taken, and I've taken hundreds of trades this year, and all of them have been posted. So I'll see you guys there. Make sure you guys like and subscribe, and I'll see you in the next one.